to another weekly episode. So, we'll quickly go through what is happening in the market, but in a format that will help you understand things on your own. And this is something you can repeat every week on your own in terms of doing homework to analyze what is going on in the market. That is, which sectors you have to focus upon and which stocks, particularly, you have to select. So, first, we'll begin with the leadership of the market. The current leadership in the market, which means the sectors that are leading the market higher, still remain banks, finance, defense, travel tourism, capital market, hospitals, cement sector, and chemical agriculture sector. So, this is broadly the fertilizer space also. These are the broadly sectors that are in leadership currently. Now, last week I had updated on my Insta profile that there are a couple of more sectors that are getting into the right kind of structures. First is metals, then is IT, IPO, and even hospitals are again setting up. So this is denoted by these dark shaded lines. So out of these, if you look at IT, IPO, capital market index, and hospitals, along with metals, these are sectors that have improved their price structure a lot, and the risk reward currently is in favor of these sectors. See the previous slide that I shared here, which already highlights the strong pockets of the market. There are a couple of sectors here that have run up a lot. There is a lot of euphoria in these sectors, namely defense, because this was a sector that did exceptionally well in the last 15 odd days. But other than this, even banks, finance are again consolidating, getting into beautiful structures, even capital market. So, what you have to do as a trader is first identify the sectors that resonate with you, that is in terms of risk reward, and then have specific patterns to target in terms of stocks. So, I'll just quickly cover these one by one. The first step always is to look at sector strength. See, inherently in the market, there are so many sectors. You cannot go behind all the sectors. So you have to identify the sectors that are best in terms of structure and in terms of outperformance, which means you first have to begin with something like relative strength RS ranking. I've included RS ranking here because these days a lot of apps exist in the market who give you some relative strength rankings. I'm not a big fan of these because they just use a textbook formula to compute RS rankings, which are of no use. There are some RS rankings that also include recent price movement with respect to volatility and with respect to the underlying trending structure. Those RS rankings are still reliable. But most of the apps in India that I've seen that give out RS rankings don't factor this. They only rank sectors and stocks based on historical performance, and that is of limited value. So if you still want to consider RS ranking as a factor to identify strong sectors, then either you can use a 4-week RS rank or a 10-week RS rank. But again, as I've written here, be careful if you're using this ranking method. The method that I use is relative strength trend, which is nothing but a ratio chart between sector and a broader market index like Nifty 500. The next you have to check is the sector breadth. Now, what does sector breadth mean? It means the stocks within the sector are trading above 50 DMA and 200 DMA. That is, you have to check how many stocks are trading. If a sector has broadly 20 names, at least 60% stocks have to be trading above 50 DMA and 200 DMA to tell you that the medium term trend and the long term trend remains positive. And last you have to check is the overall breadth. That is the overall market condition, whether it is conducive for the portfolio value to go up or not. If only 10% stocks are above 200 DMA, or only 10% stocks are in clear stage 2 structure, or only 10% are in higher high, higher low structure, then the odds that the value of your portfolio is going to appreciate over a period of time always remains limited. That is why you have to check how many stocks are above 50 DMA, 200 DMA, how many stocks are in a clear structure of higher high and higher low, how many stocks are in clear stage 2 structure, that is for those of you who are familiar with the teachings of Stan Weinstein and Richard Wyckoff, and how many stocks are in stage 4, that is distribution structure in terms of price heading lower. So these are broadly 4 steps you have to check. Now, how do I check relative strength? This is a ratio chart as an example of Nifty Private Bank versus Nifty 50 index. Post January, this is a 3-month trend that is under development. If you look, this is a pivot. This is a pivot. Now one more pivot is getting formed. This means the outperformance per se of private bank with respect to Nifty 50 is continuing. The price is also consolidating very close to 50 DMA. So it can consolidate for some more time. And then again, you'll see over time, this index will head higher. Why? Because this is what relative strength analysis that you did in step 1 here. This is what it tells you. It tells you that the sector trend, the sectors that are leading the market, the sectors that are not falling much when the market moves lower are the sectors that are leaders. And over time, these always do well and head higher. The word over time is important because what happens recently, a lot of people are chasing defense names, and then defense names have started retracing, as we discussed in the last week's episode. People tend to exit those positions thinking that the outperformance is over. Whereas what happens is periodically sectors that are leaders go under these cycles also, where they underperform for some time, they shake out a lot of shorter time frame players, and then over time they set up again and start moving high. Now the second step would be defining technical leadership. What does technical leadership means in terms of price structure? The first is above 50 and 200 DMA. Stocks that stay above these moving averages show strong demand. Again, these are simple concepts that have stood test of time. In general, you have to always avoid stocks that are below 200 DMA. So if some of you run scanners to identify stocks, this condition always has to be there, that the stock has to be above 200 DMA. It has to be above 50 DMA. And ideally, 50 DMA has to be above 200 DMA. That is when a stock is in a strong trend. Next is relative strength. Stocks outperforming their own sectors are outperformers. But stocks that are outperforming Nifty 500 and own sectors are true market leaders. This is a clear differentiation in terms of how you have to look at relative strength. I'll repeat, stocks that outperform their own sector, that is, if a banking stock is outperforming the banking index, then it is an outperformer. But if that banking stock is outperforming Nifty 500 and Nifty Bank, then that is a sign of true market leadership. You should always focus on such stocks. The third is low volume retracement. For those of you who are regular on this channel, this means stocks exhibiting tennis ball movement. What is tennis ball movement? When the stock moves up, volumes expand. When the stock moves down, volume contracts. And lastly, price and all-time high. Stocks that are near all-time high tend to break out sooner because obviously they are undergoing consolidation. They don't have any left side resistance. So the path of least resistance is always on the upside for such stocks. Whereas those stocks that have fallen 40, 50, 60% from their highs, they have to climb at least 75% just to reach the all-time high level. In between, there is so much of resistance. There are so many people who are stuck. They want to get out of their positions also. That is why stocks that remain close to all-time high are stocks with high relative strength and strong demand. You always have to stick with these stocks. Now, this is how I check relative strength for a particular stock. I cannot show the price scale, neither the name. But again, this is a beautiful trending relative strength. Stock clearly above 50 DMA, 200 DMA. As RS has headed higher, look, every dip in the price eventually gets bought. This is again a contraction forming on the chart. Pretty soon you will see one more breakout and the stock keeps heading higher. That is how strong relative strength stocks behave. If you look at the volume patterns here to tell you what tennis ball looks like, look, when this leg up happens, look at the volume. Now, when this consolidation is happening, near 50 DMA, 200 DMA, look at the contraction volume. You can clearly see a dip here, clearly see expansion here. So this is what tennis ball movement means when you're identifying a strong stock in the market. Now, the third step is to categorize your stock according to the BCG matrix, that is the Boston Consultancy Group matrix. Again, this is for those who are interested in fundamental analysis or qualitative analysis. But this is a beautiful matrix that will tell you what kind of companies you have to go behind. I'll just explain this chart here. So this is the growth scale. This is the market share scale. That is how much market share a stock has. That is from low to high. And how much fast the stock is growing. That is from low to high. So the BCG matrix essentially categorizes stocks into 4 segments. The first is stars. These are stocks that have high growth and high market share. These should be your top candidates. The second is question marks. These are stocks which have high growth, have low market share. All right. The third is cash cow. These are stocks which have high market share, but the growth rate is slower. Typically, FMCG consumption sectors come into this pocket. The last is dogs, which you absolutely have to avoid. These are low growth, low market share companies. A lot of SMID stocks, penny stocks fall into this category. Instead of using scanners, if you just based on growth parameters, simple growth parameters, you can look at P ratios, PEG ratios, earnings growth, yearly earnings growth, maybe quarterly earnings growth. If you can just categorize stocks this way, almost 85 to 90% of stocks you'll just eliminate. You won't even look at those stocks. So if you have 20 stocks in your portfolio, try and categorize based on BCG matrix. I'll tell you where it is important. It is important because you have to focus on stars and maybe question marks. As far as stocks in your portfolio falls under the star category or the question mark category, that is great. Stocks that fall into the dog category, they have to be completely sold off from the portfolio. Cash cow, it's completely your call, because some of these stocks also are dividend rich stocks, and a lot of people buy this segment just to get dividends from the market. Now, this BCG matrix is important because in position sizing, if you figure out that you have a star in your portfolio, then it becomes much easier to allocate more money. This is one of the ways you can move from a consolidated portfolio, that is a diversified portfolio, to a concentrated portfolio just by following something that the BCG matrix teaches. You should only stick with star category stocks and question mark stocks, because sometimes these question mark stocks, when they tend to prove themselves to the market, they actually migrate to this stars category. Now, the fourth step that you have to check is again basic fundamental stuff. I'm not going to repeat this because this is a slide I've taken from the Stan Druckenmiller's video. You have to go back and watch this again, but it's the basic stuff: year on year growth, sales growth, what is the compounded growth return, whether the growth is organic or not. And you can also look at quarterly growths. This is something I don't track, but of course, it will give you insight about a company. So you can go back and watch that video again if you have to understand what basic fundamental parameters that you have to track. The fifth step is, where is the government spending its money? This is one of the most crucial steps that investors and traders should never skip. And that is why you always have to understand where the government is willing to spend more money and why the government matters here. See, the following government policy and mega trends is crucial because it allows investors to position themselves along the country's economic direction. Government backed sectors often receive funding, regulatory support, something which is extremely important in our country, and long term project visibility. All of this actually translates into earnings stability and growth potential for the companies that are aligned with the government policy and the mega trend. Incorporating policy tailwinds into stock selection can give traders a structural advantage, riding long term narratives with market wide support. Look for companies positioned to benefit directly from structural policy initiatives and long term government vision. Every decade has a theme. If 2010 was all about infrastructure, capital goods, engineering, these themes repeated almost 15 years down the line, again in 2020. In between, there was IT, then there was FMCG consumption between 2010 2015. Then post 2020, there were a lot of themes: IT again, defense, railway. Again, government spending was happening in this particular direction. So this is something you again have to categorize based on which stocks you hold. If you look at the current context, from what I have gathered, there are 3-4 spaces where the government is paying some serious attention. One is the PLI schemes, that is targeting sectors like electronics, automotive, pharma, solar manufacturing. This is a space that is set to see massive growth in years to come. Then defense modernization. Last week I had uploaded a video about defense, but in that particular video I'd highlighted why companies in aerospace, shipbuilding, electronics are just going to explode in the next few years. It is always about the next few years. If you start thinking in terms of next 75-minute, hourly time frame, daily time frame, you'll always remain relatively poor in the market. If you start thinking in terms of themes, the themes that are going to play out in the next 3, 5, 7 years, that is when you can make serious money in the market. Serious money is made when you buy the right pockets in the market, and then you just sit on those pockets. Don't try and be in and out and those kind of things. The next space is the green energy EV. Again, government support is clearly visible in solar, hydrogen electric vehicles, battery manufacturing. Handful of players. As I explained in last week's video in defense, where government is focusing, there are a handful of players in that particular segment. Logistics and digital, infra-focused companies obviously get long-term visibility in terms of wherever government is backing. In this particular segment, look at firms in data centers, semiconductors, and connectivity infra. Again, this is a niche theme that the government is focusing upon. So what I'm trying to tell you here is a company that is starting with a sector, a strong sector, plus a strong company technically, basic fundamental check that everybody can do. And in the end, it has to be backed by government policy. That particular sector, wherever you are targeting, stocks that you're buying have to belong to a pocket where government is spending big, because that is when your portfolio will truly grow over a period of time. Before I move to the next segment, what I have explained till now, whether it is about sector strength, whether it is technical leadership, whether it is about sticking to quality, understanding the importance of sector tailwind and government support, is nothing but a framework that I follow when I'm doing homework about stock market. And that is what is important, whether market is correcting, whether it is having a v-shaped recovery on the upside, whether it is having a vertical drop on the downside. This is something I never stop doing, that is looking at strong sector pockets, looking at technical leadership, looking at basic fundamental things that I've already explained many a times in details, and then finally looking where government is spending money in terms of their vision of where economy has to go over the next many years. This is actually a formula that broadly you have to follow, and this is not something that I have invented. This is a formula that has been given by William O'Neill, Stan Weinstein, and a lot of investors and traders who have done exceedingly well for themselves. Now, while doing the weekly analysis for yourself, one more important aspect that you have to understand is the importance of breadth and why breadth dictates position sizing in the market. I've been updating this chart with you. Now the 50 DMA number stands at 83%. 83% stocks are currently above 50 DMA. This number has improved drastically, and it actually tells you the medium term stability is there to last in this market. The 200 DMA number is still at 46%. Now, I would want this number to cross 50, 55, 60% because that is when you can get long-term reliability in trends. As of now, we are not out of the woods yet because majority of sectors that are leading the market higher were the sectors that did not fall much between Jan to April period. This does not mean market is weak. Market is strong, but currently it is much more stronger in the stronger pockets. I would want this strength to spread across more sectors. Signs are definitely there. I can definitely see long-term charts are improving for sectors that have fallen also. But still, we need more clarification in terms of breadth data improvement, in terms of sustainability of trend. Again, signs are very good currently in the market. And the number of stocks in the higher high, higher low structure are 43%. Again, this number needs to move above 50, 55%. That is when you will stop seeing this intermittent volatility that comes about in the market, because that is what shakes you out the most in the market, along with news flow. Unless you master this, I can tell you 100% you won't be able to ride a trend, because you have to understand that news flow is designed to create panic. I will read a couple of things for you. Just pay attention here. Short term news can often shake out well researched positions by triggering emotional reactions and temporary price volatility. What are the examples of these? We saw event of 7th April where the tariff announcement came out. We saw the tensions escalating India-Pakistan border. Russia-Ukraine war is still going on. Still conflict is there in Middle East. These events cause a lot of panic selling, but the overall trend actually remains intact, and you see a V-shaped recovery happen and markets again get back to where they were. Quite recently, you've seen a lot of news about the sudden spike in 10-year bond yield in the US and how that is going to cause a panic in the stock market and a crash is coming. This is something I wrote on Twitter also, that these things are something that are designed to push you out of your positions, and you should not be too worried unless and until charts start suggesting otherwise. Down the line, you will see poor inflation data. You will again see disappointing news about poor earnings. This thing will continue. So these news events often lead to a lot of impulsive exits just before stock again resumes the trend on the upside. Traders must separate noise from signal and rely only on trend strength and the chart structure. Remember, it is not the news, but how the stock reacts to it over medium term that matters. Again, medium term is the key. It's the key because the 2021-2024 cycle is long over. This is a cycle where we are going to get news flow which is not going to be favorable for the stock market. Liquidity conditions have changed. Market breadth is poor. These kind of market data points lead to a lot of knee-jerk reactions. And that is when people exit their portfolios thinking that they'll enter again whenever charts set up. That is not how things work in stock markets. Once you have entered a trade or an investment, your stop loss is something that dictates what happens next, not news flow. News flow, who benefits from news flow? You also know. That is why you have to protect yourself from news flow. And this is one of the reasons why I spend so little time on social media. I spend almost 0 minutes watching whatever is happening in the world in terms of news, in terms of whatever commentary is coming out from the business channels, etc. Because you can control only two things: your entry, your exit. And how can you master these? By regularly doing homework in the market and then ignoring anything that falls outside of the framework, that is in terms of news flow, commentary of XYZ people, and a lot of meaningless discussions that happen on social media. So do reach out to me if you have queries. My Instagram ID is st_pyi. My DMs are open. You can definitely contact me if you want to discuss something. I'll again see you next week if there is something worth making a video about. Else, I'll see you the week after that. So have a great weekend ahead, guys. Take care and be safe.